So you've hired an investment advisor to manage your investments. Here's the question. Are they any good? How does the performance of their portfolio compare to a portfolio of simple index funds? Well, that's the question we're going to tackle in today's show. Hey everybody, my name is Rob Berger. This is the Financial Freedom Show where we talk about investing, retirement, and financial freedom. If those topics are important to you, I encourage you to subscribe to the channel. I also send out a newsletter every Sunday morning. You can sign up for that with the link below this video. So I got an email from a viewer this week. She wanted to know how to compare her investment advisor's returns that she's getting on this portfolio versus sort of a simple index fund portfolio. And it's a good question. And I'm going to walk through how to do it using a free tool called Portfolio Visualizer. And here's the challenge. A lot of investment advisors will put together what I think is an overly complicated portfolio. And in that sense, I'm being rather kind. It's an absurdity. You'll see 10 different investments, 15 different investments. I've had folks email me with their portfolio where an advisor has put them into 30 or more ETFs or mutual funds. Frankly, I think that's the most ridiculous thing I've ever seen. I could invest $100 million. I wouldn't need 30 ETFs and mutual funds, but that's just me. All right, so how do we take a complicated, let's be honest, ridiculous portfolio that some investment advisor has put together for you and figure out how it compares to maybe a 3 or 4 fund portfolio using just index funds? Well, we can do it, so let's get to it. So here's Portfolio Visualizer, and there are a couple of different ways you can actually do this. Let me show you sort of a simple way first. And we'll start with asset allocation. So this way you can use if you know how your portfolio has performed over time. Your investment advisor should be able to tell you that. So let's say you've been with them for 10 years and we'll just assume you've got 70% of your money is in various stock mutual funds and ETFs, and 30% are in bonds, just for our example. So we can set this for 10 years. So we'll set this, we'll say 2014 to 2023, if we want to compare that. You can just leave what we're really care about is the compound annual growth rate. So this will get a little more complicated if you've been regularly contributing to the portfolio, but you can still do that with cash flows, right? The question is going to be, are you contributing a fixed amount? Is it the same each month? For now, we'll assume you started with a lump sum. And so we'll leave it at 10,000. Again, our goal here is to compare not the dollar amounts per se, but the compound annual growth rate. But of course, if you started with a different lump sum, you could put that here if you know it. But again, our focus is compound annual growth rate. And then what we can do to create the simple portfolio is just use a few asset classes. So again, if we're a 70-30 portfolio, we could say, okay, we'll put, again, this could mimic or mirror whatever your portfolio looks like. And if you have trouble understanding it because they've got you in 20 or 30 different funds, you should be able to ask them. And the question would be, how much of my portfolio is invested in US stocks? So we'll just assume it's 50%. How much is invested in international stocks? And we'll assume it's 20%. That gets us our 70. And then you could get some understanding of the bond investments. Again, your advisor should be able to tell you this, but we'll just use total bond market, 30%, and we can look at the compound annual growth rate. And we can see over the last 10 years or so, the return is 6.38%, and we can now compare that to the returns that our advisor has generated for us. Now, again, this is in some ways an overly simplified approach because a couple of reasons. As I mentioned, you could be making contributions to this portfolio or withdrawals, and those would have to be factored in. But the other complicating factor is you could have an advisor that's moving you in and out of mutual funds, ETFs, and other investments on a yearly or some regular basis, and that could make comparing the returns a little more complicated. But I think what I would say to that is, all right, well, let's let that advisor move me in and out of investments. That's what they did. But how would that have compared to, again, going back to this, one where we didn't do that, where we didn't move in and out of investments all the time? We just stuck to this very basic asset allocation, in this case, just as an example, 50% stocks in the US stocks, 20% international, 30% in a total bond fund. For all of that, buying and selling that the advisor did and fees that might have been associated with that, how did their return compare to this simple approach? Now, we can actually take this a step further, and I want to show you that. We can actually put in to Portfolio Visualizer, just about any portfolio we want to, and we would do it down here under Backtest Portfolio. And what I want to do is, I've got a couple of portfolios saved that I want to show you. And the one that I want to bring in was a portfolio that a viewer sent me some time ago. And we'll look at it here. You can see it's got 18 different investments. We've got a PIMCO Total Return. We've got an American Funds Growth Fund. We've got Goldman Sachs Absolute Return Fund, Emerging Markets Fund, and on and on and on. So this is the portfolio. We can analyze it. Now, when you put in a specific portfolio like this, you want to see what date range it gives you. It's almost always going to be limited based on the data that Portfolio Visualizer has for each of the funds in the portfolio. But this gives us about 7 years of data, so that's not too bad. And we can see the return has been 5.81% over that time period. Now, to compare that, the first thing we want to understand again is how much is in stocks, how much is in bonds. Your advisor should be able to tell you that. But we can also look at it here in Portfolio Visualizer. If we go to exposure, we can see all of the different categories. So if we add up the bonds, it starts right here and going down. We can just quickly do a rough estimate, 35, 40. It's about 43, it looks like it's about 43% in short-term treasuries, long-term treasuries, maybe 43%. So we can just do a rough comparison. We'll use VTI for stocks. Since 43 was in bonds, that tells us that 67, is that right? Nope. 57% would be in stocks. And we can use BND for bonds, just again to get a rough idea. So there we are. So how would this complex 18-fund portfolio compare to a 2-fund portfolio, at least to start with? 57% in total U.S. market, 43% in its total U.S. bond. We can analyze the portfolio. I've not actually done this, so maybe this complicated 18-fund portfolio will have won out. If we go down to the returns, here we go. So in this case, Portfolio 2, which was our simple 2-fund portfolio, clobbered the complex 18-fund portfolio that some advisor had put together for a viewer, and slightly higher volatility. So you've got to factor that in. That's certainly relevant. That's what standard deviation will tell you. But the results, again, it's over 7 years, so it's a limited amount of data. But questions for the advisor would be, why am I in 18 funds when a simple 2-fund index fund a portfolio beat out the returns significantly? And by the way, we have yet to account for the fees the advisor is charging. We can actually add those in. If we go to fee structure, our simple 2-fund portfolio doesn't have any fees, but we can add, say, we'll just do the industry standard 1% AUM for this complicated portfolio number 1. And of course, that's going to just drain the returns even more. We can see now the compound annual growth rate drops to 4.78%. And so you can start having some questions with your advisor. What's the 1% getting me? Why am I doing this? Why are we doing this? Why isn't a simple index fund approach the better way to go? Now, we could try to mimic this complicated portfolio in a little more specificity. So for example, we could look at, again, it's portfolio 1 here. We could say, well, how much of the stocks are in international funds? So we can see here, developed markets and emerging markets, it's 26. I'm looking at these two numbers here. Call it 27%. So we could add some more. We could put in, well, I'll just use Vanguard's total international stock fund. That was 27%, right? Which would mean we'd have to lower the US stocks by 27%. So if I've got the math right, it takes it to 30. Yep. So now we've gone from a 2-fund portfolio to a 3-fund portfolio. Again, the reason I've done that is it allows us to put in the amount of international exposure comparable to this complicated fund. Now notice what I've done, by the way, before we look at this. I can go down to this exposure tab and see how much is in this case, international stocks, US stocks, and so on. Notice what I haven't had to do. I haven't had to go through and analyze every single one of these funds. It doesn't matter. I don't need to do that. I can just see what asset classes are represented in that portfolio as a whole. And I think that's an important point, because if you've got an investment advisor that's got you in 18 funds or more, it can seem overwhelming. How in the world can I get my arms around that? Well, you don't really need to, at least on a fund by fund basis. You can just look at the overall exposure and see what asset classes that portfolio is tracking. All right, so if we analyze this, I'm going to guess they're going to come a little bit closer in performance. Let's see. Well, so this has come down a bit, and that's because over the last 7 years, U.S. stocks have outperformed international. So when I added some international to the portfolio, it brought the overall compound annual growth rate down, but still beating out the complicated portfolio. And again, I'm using that 1% AUM, but still pretty significant. And what I would do with this is I would use it to have some serious discussions with the advisor. What's the value of the 1% or whatever fee you're paying? And even apart from the fee, why aren't we in a simplified portfolio that I can, the customer, the client, can better understand than this 18 fund ridiculous portfolio? Now, I can also come back up here and we can get rid of this fee structure for a moment just to compare the two portfolios. They'll probably become very, very close at this point. Let's take a look. Yeah, so in this case now, the advisor portfolio has slightly outperformed. Now again, we could refine this even more, by the way, because when we look at exposure, we can see that the advisor fund had 35% in short-term treasuries. And as we know, last year was a really bad year for intermediate and long-term bonds. So we could come in and we could add yet another fund. Let's just do it. So I would put in a Vanguard. Let's search for I want a short-term treasury. Here we go, Vanguard short-term treasury. And how much do they have in that? They have 35%. So that's quite a lot, actually. So we'll take the 35% here. Now that means we've got to reduce the B and D by the same amount. So that puts us at 8, I think, right? Okay. So you can see what I'm doing. I'm sort of taking it layer by layer to use index funds to more closely represent the complicated advisor portfolio. Again, they're using 18 funds. We don't need to do that. With just these 4 funds, we're probably coming real close to the overall exposure that the portfolio is giving the client. And so if we look at returns, so now they're really, really close. I guess the advisor portfolio in this hypothetical is outperformed by about 26 basis points. Again, obviously, if we come up here and add the fee structure back in, and I'm just assuming 1% AUM, then of course the simple index fund portfolio will win out. Let's just take a quick look. Yeah, 5.5% versus 4.7%. So there you go. That's I think a fairly straightforward way to compare a complicated advisor portfolio with a simple portfolio of 2, 3, 4, maybe 5 index funds. And again, it doesn't necessarily mean that you call up your advisor and you fire them, although it might. But I do think it can be the start of really important conversations with an advisor that's put you into a complicated portfolio, which frankly, I would define a complicated portfolio as any portfolio than more than maybe about a half a dozen funds. Now, again, if you may need to have more than that because you have certain funds in a 401k and you've got to select those, but in your IRA, you'd prefer to use Vanguard or Fidelity funds. So that's fine. But when you get into a portfolio where an advisor's got 10, 15, 20 funds, certainly more than that, I think it calls for some serious questions for that advisor. And by using Portfolio Visualizer to compare your complicated portfolio with a simple portfolio, and you could try different things as I've walked through today, I think that can arm you with some really good questions and data for your advisor. So there you go. I hope you found that helpful. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. Until next time, remember, the best thing money can buy is financial freedom.